Why 90% of Forex traders fail within the first year, and how to avoid it. Did you know that nearly 90% of Forex traders lose all their money within the first year? That's 9 out of every 10 traders who start with big dreams of financial freedom, only to end up frustrated, broke, and walking away. But here's the question: why does this happen? And more importantly, how can you avoid becoming just another statistic? Stay with me, because in this video, we're going to uncover the real reasons most Forex traders fail, and I'll show you the strategies and mindset shifts that can help you succeed where others give up. Welcome back to the channel. If you're serious about trading, or even just curious about why the Forex market seems so brutal for beginners, this video is for you. Most people think traders fail because they don't know how to analyze charts, or because they picked the wrong strategy. But the truth goes much deeper. What really separates the 90% who fail from the 10% who succeed isn't just technical skills. It's psychology, discipline, risk management, and having a long-term perspective. So, let's break it down step by step. Section 1. The illusion of quick riches. One of the biggest reasons new traders fail is because they enter the market with the wrong expectations. Everywhere you look, you see ads promising to turn $100 into $10,000 in just a month, or influencers flashing cars and luxury lifestyles funded by Forex profits. This creates what I call the illusion of quick riches. Beginners jump in thinking Forex is a lottery ticket, not realizing it's actually a skill that requires years of learning and discipline. The problem? When they don't double their account in a week, frustration sets in. They start over trading, increasing lot sizes, and eventually blowing their accounts. The hard truth is, Forex is not a get-rich-quick scheme. It's a get-rich-slow, if at all, with the right mindset and patience. Those who understand this early already put themselves ahead of the majority. Section 2. Lack of risk management. Let's talk about the number one account killer: poor risk management. Most beginners focus only on how much money they can make on a trade, but they ignore how much they can lose. Think about it. Professional traders risk only 1 to 2% of their account on a single trade. That means if they lose, they live to fight another day. But beginners? They'll risk 20, 30, sometimes even 50% of their account on one setup. One wrong move, and the account is gone. The truth is, consistent success in Forex doesn't come from winning every trade. It comes from protecting your capital long enough to let the odds play out in your favor. If you don't master risk management, you don't stand a chance. Section 3. Emotional trading. Now let's dive into something even more powerful than strategy: emotions. Fear, greed, and impatience are the silent killers of Forex accounts. Here's how it plays out. Fear makes traders exit too early, cutting their profits short. Greed makes them over-leverage and chase the market. Impatience makes them trade setups that don't really exist just because they want to be in the game. This is why psychology is often said to be 80% of trading success. You can have the best trading system in the world, but if you don't have control over your emotions, that system won't save you. Professional traders learn to detach from outcomes. They follow their plan regardless of whether the last trade was a winner or a loser. That emotional discipline is what sets them apart. Section 4. Overcomplicating strategies. Another trap beginners fall into is constantly switching strategies. They start with one method, lose a few trades, then jump to another. Then they add more indicators, more signals, more complexity. Before they know it, they're paralyzed by analysis and nothing makes sense anymore. Here's the truth. Consistency beats complexity. Even a simple moving average strategy can be profitable if you apply it with discipline, patience, and proper risk management. What matters isn't having a perfect strategy. It's sticking to one long enough to let the edge play out. Section 5. No trading plan. Most beginners fail because they trade without a plan. They open their charts, see a candlestick that looks interesting, and jump in. That's not trading, that's gambling. Successful traders treat Forex like a business. They have a plan that defines when to enter a trade, when to exit, how much to risk, and what setups to ignore. Without a written plan, you're at the mercy of emotions and randomness. With a plan, you give yourself structure, discipline, and a clear path forward. Section 6. How to avoid becoming a statistic. So, how do you avoid joining the 90% who fail? Here are the keys. 1. Set realistic expectations. Don't chase overnight riches. Aim for steady, small growth. 2. Master risk management. Never risk more than 1 to 2% per trade. Protect your capital. 3. Control your emotions. Develop patience, discipline, and the ability to detach from wins and losses. 4. Keep it simple. Stick to one strategy and refine it. Don't chase every shiny object. 5. Build a trading plan. Write it down, follow it, and review it regularly. If you follow these steps, you won't just survive your first year. You'll build the foundation to thrive long-term. The truth is, Forex trading is tough. The odds are stacked against you if you approach it like everyone else. But if you commit to the process, protect your capital, and master your psychology, you can put yourself in that 10% who succeed. So now I'll leave you with this question. Do you want to trade like the 90% who gamble, or like the 10% who treat Forex like a business? If this video opened your eyes, make sure to hit that like button, subscribe for more trading insights, and share it with someone who's thinking of starting their Forex journey. Because the more we spread the truth, the more traders we can save from failing before they even begin. Thanks for watching, and I'll see you in the next video.